Hi, I'm Ifti, and welcome to Click's weekly market newsletter for the week ending the 19th of December 2025. Let's look at what happened in the final full trading week before Christmas. Markets delivered a very familiar December pattern: selective strength, falling volatility, and thinner liquidity shaping price behavior more than big headlines. This was an important week to understand, not because it was dramatic, but because it shows how markets behave when structure and positioning matter more than news. This snapshot shows performance across major indices, commodities, FX, and volatility. The key takeaway here isn't just who went up or down, it's the dispersion. Tech and megacaps led, volatility dropped, silver surged, oil softened, and FX remained largely contained. This type of mixed performance is typical of December markets, where capital becomes selective rather than broad. Central banks continued to set the tone. Even without new decisions, markets were still responding to the Federal Reserve's December stance, particularly its refusal to promise aggressive future rate cuts. What mattered wasn't action, it was messaging. The tightening phase appears largely complete, policy remains data dependent, and there are no easy money promises on the horizon. Relief, not celebration, drove price action. Equities found support, volatility eased, and the US dollar held steady rather than weakening. As December closes, large institutions follow predictable patterns. They reduce exposure to smaller, less liquid assets, rotate capital into high liquidity names, and concentrate risk in index heavyweights. This creates the narrow leadership we saw this week, where markets rise but participation shrinks. Nasdaq gained 1.48%, the S&P rose 0.91%, while the Dow and Russell lagged. When markets rise without broad participation, positioning, not optimism, is usually the driver. Volatility fell nearly 10% this week, and that matters. Lower volatility reduces institutional hedging, encourages systematic buying, and makes markets appear calmer than they truly are. But this doesn't remove risk, it compresses it. Low volatility often feels safe, right up until it isn't. For newer traders, this is a crucial lesson. Calm markets can still carry sharp surprises. FX markets spent the week largely in pause mode. Most major pairs moved modestly, signaling a market waiting for catalysts. The exception was US DJPY, which rose over 1.3%, driven by rate differentials and sensitivity to Japanese policy expectations. FX often moves before policy changes. Anticipation alone can drive flows. In commodities, gold held a steady defensive bid, silver surged on momentum, and crude oil softened amid demand concerns and holiday week liquidity. Different commodities react to different emotions, not just supply and demand. Equity leadership was selective, not broad. Tesla, Meta, Nvidia, and Microsoft led the upside, supported by liquidity, institutional confidence, and defensive growth themes. Alphabet underperformed sharply, Apple drifted lower, and Amazon was essentially flat. This concentration is typical of year-end positioning and often precedes either a broadening rally or a reset once fresh capital enters in January. Crypto markets softened across the board this week. Bitcoin, Ethereum, Solana, and XRP all finished lower. But notably, there were no major negative fundamentals. Instead, market structure told the story. Institutions reduced exposure ahead of year-end, retail flows became dominant, and thin order books amplified price movements. In these conditions, crypto can go from quiet to chaotic very quickly, and small orders can create outsized reactions. Looking ahead, the Christmas trading reality is simple. Lower liquidity plus fewer participants equals bigger surprises. Early in the week, we have key data, particularly Tuesday, which is the most important session. After that, market closures begin across the UK and Europe, and liquidity drops sharply. This is a week where risk management matters more than activity. Weeks like this remind us that markets don't move randomly. Price behavior follows structure, liquidity, and incentives. Expect patchy liquidity, especially in FX crosses, oil, and high beta stocks. Headlines get amplified in thin markets. Tuesday matters most. And sometimes not trading is a position. This is exactly the mindset we build at Click Trading Education: process-driven, risk-aware, and grounded in real market behavior. And before we wrap up, we just want to say thank you. Thank you for being part of the Click community this year. Whether you've been trading with us, learning with us, or simply following along and building your understanding of how markets really work. We hope you have a Merry Christmas, a restful break, and a chance to step away from the screens, because good traders know when not to trade as well as when to step in. If you're looking ahead to the new year and want to build a proper process-driven approach to trading, our next Forex and CFD on-site course takes place at our Lincolnshire Centre from the 15th to the 19th of February 2026. It's hands-on, practical, and focused on understanding markets, not chasing signals. Details are available if and when you're ready. And if you found this newsletter useful, don't forget to like, follow, and subscribe. It really helps us grow the community and keep delivering clear, no-nonsense market education. Enjoy the holidays, take care of your capital, and we'll see you in the new year.